Hello everyone, I'm Sahil and welcome back to the channel. For the ones that are new, through this channel, I'm documenting my journey to financial freedom just to keep myself on track, and hopefully it is also useful for somebody like you watching these videos. So at the start of every month, I share my personal financial position and also the changes in my investment portfolio together with some news to update you guys. So if you are interested to tag along in this ride, just make sure to subscribe the channel. As the title suggests, today we are looking at JD.com, one of the two growth companies that I have in my portfolio. As usual, the video will be divided into 5 different segments. Firstly, we'll be looking at the company itself with the business overview. Then we'll look at the different competitors, followed by the financials of JD, and then my investment thesis into JD. And lastly, we'll be ending off with valuation. So let's hit it out. JD.com is primarily a tech-driven business-to-consumer e-commerce company headquartered in Beijing. As of 2021, they are the largest retailer and second largest e-commerce platform in China with over 471 million active users. They buy inventory directly from companies, making sure the products are genuine. They own their own storage, fulfillment facilities, and a delivery network through which they sell the products directly to the consumer through their mobile app and website. JD is currently traded on Nasdaq under the ticker of JD and also on the Hong Kong Stock Exchange under the ticker of 9618. In terms of differences, if you buy a US listing, you have the advantage that there is no minimum lot size, so you can even buy one single share if you want to. And also you get access to the options market where you can use it to buy in by selling puts or even make some money while you're holding the shares. For Hong Kong Stock Exchange, you have the advantage that there is no apparent risk of them getting delisted, unlike a US listing. With that covered, let's look into the various business segments of JD. So firstly, we have the e-commerce business, then we have the logistics business, and thirdly, we have the new technology businesses. So for the e-commerce, I've already covered the basics, but if you want to explore more, we can actually split the segment into 2 different categories. The first is the retail category, and secondly is the marketplace service platform category. For the retail category, the company JD itself goes and buys the inventory from various different companies and brands and sells it to the end consumer. This is exactly how a traditional retail store would operate. The second category, the marketplace service platform, lets other people to put on their listings on the company's website and sell them to the end consumers. This is something like eBay or Shopee, if you are more familiar with them. So while JD.com, the company's main e-commerce platform, comes under the retail category and mainly focuses on providing high quality branded products to consumers in tier 1 to tier 2 cities. They also have Jingxi, which is the social e-commerce marketplace service platform that targets price-sensitive consumers in smaller tier cities, tier 3 to tier 6, and rural areas. If you're not familiar with the different tiers of cities, and just know that in China, cities are divided into these tiers according to their economic development levels. So tier 1 cities are the highest one, which is like Shanghai and Beijing, and then it goes down from there. So coming back to e-commerce, in China right now, the community group buying concept is becoming very, very popular, which basically is like having a group leader that collects the orders from the various members in the community and goes out, buys the product at a discounted rate since he's buying in bulk, then comes back, distributes it amongst the people who made the order and earning a commission while doing this. This feature is supported by Jingxi, but it only makes a small portion of the business right now, but has strong growth potential going forward. I'll talk more about it and how it fits perfectly in the big picture of the company in my investment thesis later. As a whole though, the e-commerce business definitely is the core business of the company, as it represents 90% of its revenues and 158% of their net profits. This is more than 100% because the other various business segments are not making a profit right now. Moving on to JD Logistics, which is the logistics arm of the company, as the name suggests, and it is responsible for all the fulfillments. This is the most essential part to get right in an e-commerce business if you want to win long term, and JD has definitely pushed a lot in this sector. They currently have over 900 warehouses within China, which covers more than 99% of the population. For comparison, this is significantly higher than that of Amazon, which is at 185 warehouses worldwide. This logistics system is so efficient that more than 90% of their orders are delivered on the same day or the next. JD currently owns 79% of JD Logistics, which is expected to be diluted since they have already filed for a listing of JD. They're spinning it off and listing it on. Sorry for the thunder, it's raining over here. So yeah, JD Logistics is being listed on Hong Kong Stock Exchange. So the stake of JD's, the parent company in JD Logistics, will be diluted, but they are still expected to have more than 50% of stake in it. Now, lastly, we have the new business segment, which comprises a lot of different businesses they have, but we'll cover three main ones. Firstly, JD Health, then we have JD Financial and Digital Technology, and lastly, JD Property. JD Health is a telemedicine and online medical consultation platform, which is currently also listed on Hong Kong Stock Exchange, and JD owns 67.5% stake in it. Then the JD Financial and Digital Tech, which covers microfinancing, insurance, and investments. And JD owns 36.8% of this business. They are planning to merge it with their JD Cloud and AI business and restructure it into JD Technology. Lastly is JD Properties, which mainly develops and manages the various different storage and logistic facilities for JD. They also have a property fund with over 2.8 billion USD in asset under management. The new business segment as a whole generates 5.7% of total revenues and is at an operating loss at the moment. Now let's move on to the second part of the video with the competitive analysis. The two main competitors of JD are very well known, Alibaba and Pinduoduo. In terms of e-commerce, Alibaba is the biggest player in China right now with over 55% market share, followed by JD with 17% and then Pinduoduo with 8%. Alibaba and Pinduoduo are mainly the marketplace service platforms. Unlike JD, they don't own and hold any inventory, and they also don't have to worry about fulfillments as it's handled by the sellers themselves. Hence, their operating cost is way lower than JD in comparison. Even though the asset-light business models of Alibaba and Pinduoduo are preferred by investors, but I am quite drawn to how JD has merged the asset-heavy and the asset-light business models together in perfect harmony. It is mostly inspired by Amazon, but in many ways it's made better. Their chain of warehouses and their logistics network not only makes product delivery fast and reliable, but also allows many high-end foreign brands to access Chinese market without having an office or a physical outlet in the country, which Alibaba and Pinduoduo can't easily replicate. Like, they need time to build up this logistics chain in order to compete with JD in this area. So yeah, this gives JD a very big business moat right now. So talking about Pinduoduo, they are actually the original Jingxi. They were the one who originally came up with the community group buying idea or the concept. And yeah, JD just copied the idea. Back in the days, the near miracle growth of Pinduoduo, it grew very fast. It sent chill to Alibaba and JD because they were already under pressure from the slowing Chinese economy and the saturated market in the big cities that both these companies were operating in. Now Alibaba also has their own initiative in this space called the Juhusu something. So they have their own initiative as well. I don't know how to pronounce the name. What sets Jingxi apart though is their direct factory to consumer approach instead of going through other retailers, and also its backing of the logistic power, which is able to ensure like everything works properly, and they are also able to maintain the quality. So that was the marketplace service platforms, and looking at the retail business, which is what JD mainly does, is very similar to what Costco or Walmart does, with the only difference being that JD is entirely online. So yeah, in terms of retailer, JD is the biggest player in China right now, followed by Suyin Group, which is a traditional physical store player with some online presence. Alibaba recently came into the picture as well in the retail category and currently stands at the 5th place within China. We'll take a look at JD's financials now. So as of December 2020, its revenue has seen significant growth with a compounded annual growth rate, the CAGR, of 32.7%, which is higher than the overall market CAGR of 20.6%. This is not a surprise as JD is currently in its growing phase as well, and it is easier for it to scoop up more market share as compared to, let's say, Alibaba. But nevertheless, it is great to see such growth. JD first went net income positive in 2019, and there's no looking back with their net income margins of 6.6% in 2020. However, don't take the 2020 figures at its face value, because if you look at their income statement, their net earnings are five times higher than their operating income, which is not normal, right? Net earnings are usually lower than the operating income because there's like additional taxes and other things that are being deducted after operating income to get to the net earnings. So yeah, we gotta look at their income statement to find out why is it so. So if you look there, what is making the extra income is the gains and losses from their investments. To know what exactly this is, let's go into their annual report where they will explain each line item in details. This is the net increase in the value of their investment into various public and private companies. So this is something that is not going to continue every year, so it's just one-time thing, and we should be careful when valuing the company. Looking at the growth of the company. So it would be better if we look at the gross profits to get a clear picture of the growth in the earnings. So JD reports two figures, as you can see here. The pink one is the gross profit, and the gray one is the gross profit after the fulfillment expenses. I am more interested in the gray one because actually that is the gross profit in my opinion, or I mean that should be the gross profit anyways. So the gray one shows an impressive growth once again at a CAGR of 44%, with the margins creeping up as well from 5.4% to 8.1% in 2020. Now looking at the operating cash flow, we can see that the growth is in line with the net earnings, which is what we want. And we can also see that the capital expenditure is diverging from the operating cash flow, which means that they can get more and more growth while keeping the reinvestments low, which is great. And they can use the spare cash to like maybe acquire more companies and grow more. JD's debt level is also quite low at 31.5 billion yuan. Its cash at 86 billion yuan itself is enough to cover all the debt, and we are not even looking at the short-term investments right now. But the thing is that they have been raising money by issuing additional shares, diluting the existing shareholders, especially with the HK listing where they issued 89.5 million additional shares. However, I believe going forward, they will not have this issue they don't have to issue more shares since they're already operating, they're already profitable. Yeah, and their cash flows are good as well. Now let's move on to the fourth part of the video, my investment thesis into the company. And I have two for you guys today. Firstly, it's China's push towards consumer-driven economy and JD's differentiated business model. Secondly, we have JD's strong backing from Tencent and Walmart. So for the first one, China's push towards consumer-driven economy. This is again something that I have discussed multiple times in the various videos I have done in the past, and actually is a very big reason I'm invested so heavily into China right now. So for decades, China has pursued export and investment-driven growth model, which has powered the once backward nation into becoming one of the biggest, not biggest, but the largest trading country in the world. But in light of a fundamental structural shift in the economy and mounting external risk, this is about to change in the coming years. As higher wages and tariffs are making Chinese goods increasingly expensive, it is becoming more and more evident that the unsustainable model of made in China is coming to an end. China desperately needs a shift towards a domestic consumer-driven economy in order to avoid a middle-income trap. For the same, the policymakers came up with the new strategy called the dual circulation model. This is part of their 15th five-year plan from 2021 to 2025. The mechanics are simple: prioritize domestic market and internal circulation to continue growing without overly relying on exports or international trade or external circulation. They want to increase household income and also nurture new consumption. Now, this is great for e-commerce players, but especially for JD, as it's a business model. The main business model is focused on high quality products, which is targeted towards the middle and high income group. By buying their inventory directly from the various companies and brands, JD is able to solve one of the biggest problem in Chinese e-commerce market, which is the sales of fakes and counterfeits. While Alibaba and other e-commerce players are mostly focused on the low quality products and maybe business to business products with a passive approach towards the products not being up to the quality, where like the consumers have to file a complaint and there's the entire process, investigation and so forth, which takes a lot of time and it is a hassle for a consumer. So this type of model is really not suited for luxury products where customers are not that price sensitive but service and quality sensitive. JD has invested a lot into this space, especially in their warehouse and logistics facilities, placing them at the perfect place to enjoy what's coming in the near future. For the second thesis, JD is currently owned 17% by Tencent and 9.3% by Walmart. So now, one thing everybody would agree with is that Walmart's supply chain and logistics management played a huge role in their success in US, and their efficiency is especially necessary in short shelf life products such as groceries. Groceries is one of the products that are mostly bought offline, but with the onset of a pandemic, it got fueled and everybody was buying this online. In Singapore itself, we have Red Mart, which is, I think, doesn't have that much market penetration right now. But yeah, in China, this is growing rapidly, and in the past 1 year, a lot of companies are focusing in this area, including Meituan and JD being one of them. So with Walmart's support, JD is able to achieve what they have in terms of logistics and supply chain management right now, and this is going to help them for a long time. Secondly, comes the Tencent. We have already discussed about JD's Jingxi platform, which offers community buying, group buying feature, an idea that was copied by Pinduoduo. Now, Tencent's WeChat had a big part to play in Pinduoduo's success because Pinduoduo users were using WeChat to share links and take orders for different items in order to secure a bulk discount. So in September last year, though, WeChat started to block external links with commercial purpose out of fear that this would impair WeChat's user experience. This means that customers can only share e-commerce items from WeChat's mini programs and not HTML links now. WeChat's mini programs are like downsized version of standalone app within WeChat itself. These mini programs are playing increasingly important part in Chinese e-commerce, especially in these group purchases. It is also better fit for consumer in the small tier cities who may have cheaper phones with less memory and do not want to download individual apps and additional apps. WeChat added Jingxi on its interface on 31st of October to kick off a Singles Day promotion, and within just 1 hour of doing so, Jingxi's mini program booked over 1 million orders, and within 1 day they sold 60 million items in total. So this is all great, but I would like to highlight that Tencent is also invested into Pinduoduo. So being able to use WeChat is an advantage that both has over the equivalent from Alibaba. However, I'm still more bullish on JD than on Pinduoduo because firstly, JD is already profitable, Pinduoduo is not. Secondly, Pinduoduo is mainly fighting in a price sensitive environment, which is an area that I personally do not invest in. And thirdly, and most importantly, I like where Jingxi fits in the overall business of JD and in the big picture. Like I mentioned earlier, right, JD's main business is selling high-end products. It has more margins, bigger moat, and customers with higher spending power. JD, in my opinion, is just using Jingxi to acquire customers. Their main goal is just that, and it is easier for them to acquire customers when they are price sensitive because just by offering them discounts, they are able to pull them over. And as the disposable income grows, it is easier to switch them to the real cash cow, the high-end products. This is linking back to the first thesis where household income in China are increasing rapidly. But I also see this strategy working specifically well within teenagers who are still studying and they don't have an income, so they are price sensitive. But soon they're going to start working and they will have higher spending power. So yeah, they can switch them easily to JD's main platform with high-end products. So it's going to work like butter. I'm currently invested in JD with 100 head shares, Hong Kong shares, with an average price of 335 Hong Kong dollars. But is this a good price to buy in? Well, let's move on to the last part of the video with valuation to figure that out. Alright, so to value JD, I'm using the discounted free cash flow model, and the discounted free cash flow model just assumes that the value of the company is the present value of all the future cash flow. So you just take the future cash flow and discount it at the present rate. But to come up with the future cash flow, we have to assume certain things. And I have made my assumptions, but I would also link this Google spreadsheet in the description below. So you can just open it up, make a copy, and change the assumptions accordingly to suit what you think might be more conservative or whatever approach you want to take. I can't explain how DCF works completely, but I will definitely make a video of this in a near future if you are interested. But for now, let's go dig in. Over here on top, I have the revenue. So the pink one is the actual numbers from the past, and the green ones are something that I have inputted myself. And I've actually taken this off from like the until 2023. I've taken it from the analyst projections, and I agree with them because, like, the growth rate seems reasonable, and also they have adjusted for the one-time gain through the investments, which we talked about earlier. Like after the operating income, they had a sudden increase for the net earnings. So yeah, they have adjusted for that, and yeah, I completely agree with their projections. For 2023 onwards, I have just used 15% as their growth rate. Okay, and for the net profits, again, I have used the analyst projections. And yeah, after taking the revenue, right, I've done my own analysis as well into different line items for what I could project, and then this number actually seems very reasonable, so I'm gonna go with it. And yes, so as you can see over here, so 6.6% net income margins in 2020. That is because of the gains in investment, and then you can see that it has actually decreased going forward. So yeah. Okay, so over here, this column is just used to calculate WACC, which is the weighted average cost of capital, which is what we're going to use for our discount rate to discount the future cash flow to get the present value. The risk-free rate is for China's 10 years bond yield. Data from Yahoo Finance. The market returns just 10%. This is a random number. You can change it if you want to. And then we have market cap, which is also like, I think the market cap is, I forgot what share price value I used for it, but yeah. Okay, so required rate of return is calculated using all these various numbers that I have here. And to calculate the free cash flow, I'm just using a simple formula. This is not what a free cash flow is exactly. So you will see that the free cash flow for the past the actual numbers do not tally. It's just because my free cash flow calculation is just based off the cash flow from operation minus the capital expense. I'm not using the net borrowings or issuance of the shares and everything, because that is something I can't predict for future. So I think this is a more reasonable take to get a fair value. Yeah. So as you can see over here, the free cash flow rate is all over the place, right? So I'm using 70% as my free cash flow rate. So 70% of the net profits become the free cash flow. So that's how I get the free cash flow for the rest of the years, the future that we predict. And then for the terminal value, I'm using the perpetual growth rate of 4%, which is quite reasonable for China's 6% overall growth. And yeah, I think 4% is quite reasonable there. Okay, then after that, yeah, we calculate the present value of future cash flow. After that, we just add them all and we'll get the total value of the company, and then we can divide it by the total outstanding shares, and we'll get the fair value of the company today, so which stands at 340 Hong Kong dollars per share. So yes, but all this number is like totally reliant on the assumptions you make. So if I remove any of the number, it's gonna dramatically change the value of the company, right? Let's say for the free cash flow rate, we can be more conservative and we can take 50% as the free cash flow rate, and you'll see that the number changed significantly. It's like a more than 30% dip. So yeah, fair value calculation is entirely dependent on the assumptions you make. That's why I'm going to leave the spreadsheet in the description below, so you can actually explore it in your own time. So JD is currently trading at around 300 Hong Kong dollars per share. And if we take $340 as the fair value of the company, then we can say that it's currently at a discount of 11.76%. If not, I mean, this is the first time I'm actually investing into a growth company as well, and I think it's fair to like put in a bit of premium if you like the company, and I firmly believe in what JD is doing right now. So I am comfortable investing in them, and I will keep on investing as the price keeps on dropping or whatever the case might be. So yeah, that's all for today's video. I hope you enjoyed, and once again I would like to put a disclaimer that do not take my views and opinions as an investment advice. It is just me sharing whatever I have invested in and the reasons I have invested into the company. So yeah, I guess I'll see you in the next video. Ciao.